What a difference a year makes, or does it with respect to affordability? That's what we're going to talk about today.
Yes, we have seen prices continue to slide as interest rates have increased over the past few months, but we want to take a look at what it's going to cost you to carry the average mortgage now versus the peak of the market, and whether or not there's any actual difference in what your monthly affordability is going to be.
So let's jump right into the numbers. Let's rewind to January of 2022, which is almost the peak of the market. The average sales price in Durham region was $1.175 million. And at that time, the average 5-year fixed rate was 2.99%. Assuming a 20% down payment, you were holding a mortgage of approximately $940,000, and your monthly mortgage payments were approximately $3,950 a month, making your balance at the end of this 5-year fixed term approximately $835,000.
Okay, now let's jump forward in time to the most recent stats that we have, which would be December of 2022, where the average sales price for a home was $892,000. Now, the average 5-year fixed rate at that time was 5.29%, and assuming that you're putting 20% down on your mortgage, you're going to have a principal balance of just over $714,000 to pay off. So here's where things get interesting. If you take a look at what your monthly costs are going to be to carry that same mortgage, you are looking at about $3,935 a month.
So basically it's a wash. You're spending $15 a month less to carry a mortgage now compared to the peak of the market last year. But is it really a wash? And the short answer is no.
Now, there are a lot of variables at play, but first we want to talk about why prices have decreased over time. What we're seeing is that the real estate market has actually been very efficient in decreasing very relative to the increase in interest rates. We haven't actually seen a dent at all in terms of the affordability metric, which is the percentage of monthly income to the percentage of monthly expenses toward housing. So what is the difference between buying now and buying at the peak of the market?
Well, the real difference lies in the principal amount owing on your mortgage at the end of that 5-year fixed term.
So if you bought at the peak of the market last year, when you come up to the end of your 5-year term, you're going to be looking at having a principal balance of $835,000.
And if you bought this year, that same house at the end of your 5-year fixed term, your balance owing is going to be $657,000.
So this presents us with a difference in principal balance of just over $177,000.
Now let's assume mortgage rates stabilize. When these two buyers come up for renewal, buyer A's monthly mortgage payments are going to be substantially higher than buyer B who purchased in this market.
So what's the future outlook for housing affordability, and is now the time to buy, or should you wait even longer? Well, the truth is it is very hard to say. On one hand, affordability hasn't even been touched from where it was previously, which means that if you're looking to buy now versus buy back then, you're still paying a lot of money compared to what your monthly income is going to be. And it's going to be interesting to see whether or not the housing market further corrects to adjust for that. On the other hand, as rates stabilize and buyers potentially gain more confidence in the marketplace, it could see them help support the increased prices that we've been seeing for a while. And anecdotally speaking, we have seen increases in buyer activity starting in the month of January. So I think this year, with rates stabilizing, it will be very interesting to see what happens to our market.
So these are the facts just leading up to this point. We want to hear what you think with regards to your predictions on what's going to happen in the market. Get out your crystal balls, comment below. And if you found this information helpful, please like, share, and subscribe to our channel. And stay tuned for more information about the housing market.